I'll be looking for it.
Thank you very much. I find it inconceivable.
Okay, so we have basically three parts to this presentation. And the first part has to deal with the state and the city and all of our problems and why we'll need a public bank, which leads into the second part. So basically the first part will be familiar because everybody knows that we're all tight on the budget and everything that's being cut and taxes can't be raised because people can't pay anymore. And so we have this big debt and there seems to be no way out, but then we'll see what can be done and what way out there is. So the familiar refrain is that we don't have any money. This is what all the government officials tell us all the time. So the options basically for that are limited to cutting spending, raising taxes, borrowing money, or selling off public assets. And I really hate the last one because it means our public commons are basically being sold off to the highest bidder, or maybe even not that high a bidder. Can everybody hear me back there?
Oh, yeah.
All right, I have to get out of the way again. I think I'm okay. All right, so the argument is getting a bit old. So we need to find another way. So there's Chairman Bernanke, ex-Chairman Bernanke. This slideshow goes back, I should actually say the slideshow is actually three slideshows in one. I've got slides from different parts. So this is the original slideshow from Public Banking Institute, and you can tell that by the bottom. When the background changes, it'll be a different kind of thing. But this goes back to 2011, and so Chairman Bernanke was chairman then. And so he was approached, and people said, well, how come you can't bail out the municipalities and the cities? And he's not actually allowed to do that. Legally, he's not allowed to do that, so that's off the table, and it's still off the table with Janet Yellen. It's not a question of if, it's just that they cannot. So we can't get a rescue from them. And it's unfortunate because only, at least at the time the slideshow was made, 191 billion would actually bail out all the municipalities and all of the debts that all the states have. So, 16 trillion, according to Bernie Sanders' audit, has gone to the banks. And as a matter of fact, Professor L. Randall Wray of the University of Kansas City in Missouri said it's 29 trillion if you count all the rotating loans, in other words, they're reinvested. And those loans have never been paid back. And then the guarantees and so forth, and all the European banks that also got our money to bail them out. And unfortunately, it doesn't seem to work. So they have all this money and they're still having problems, and we're not seeing the benefit of it. I mean, if you can imagine even a tenth of that, 2.9 trillion, in our economy would have done so much good, and we don't even have that. So this money, as we'll see later, does not really go into the economy, it goes into bank reserves and doesn't really help us. Okay. So one of the things that keeps happening now is because we don't have money to directly pay for things, is that we have to pay interest on everything that our governments do. So that's about 40% of the cost of public projects, because you've got compound interest and these projects tend to go out year after year. And so the interest piles up, and meanwhile you're not getting any return on your investment until it's actually done. So until a road is built or a bridge is built, you don't see the return on that investment. So here's some examples according to Marguerite Kennedy. She has a document which you can see on the bottom down there. And by the way, this slideshow, I'm going to give you the place to get this, so don't worry about having to write down all these little funny URLs. I'll show you where you can get this later. So drinking water, the cost of interest on that is 38%. Public housing, because they have to have so much capital stock, that's very high at 77%. Basically, they're remortgaging all the time. Garbage collection's a little less, but on average, it's 40%. So this is where a lot of our money is going. And if you have a new project, like for example the high-speed train that they've been proposing to do in California for a long time, that can be almost half, the cost of it will be half in interest. So as a matter of fact, the Bay Bridge was half of the cost was $6 billion in interest because of the time and the compounding. And the bullet train is almost half as well.
You're standing in front of that screen, so we can't see
Sorry.
it.
Okay, so I'll try to stay over here. And you know what, I'll move everything down
Move your
here.
computer
Why don't
over.
you push the box this way?
You can move your
Yeah.
computer, yeah.
Let's just do that.
You know, move this table over here.
I can't move the table because then we'll lose the projector, but that's okay. We can just do this.
Yeah, move to that table down there, yeah.
That'll be in the way of people on that side, but that's all right. We'll manage. Okay, so that's what's happening now. About half of California's obligation is, well, they'd be, without the debt, they'd be $72 billion richer without interest, because they have general obligation and then they have all this interest they have to pay. So there's $92 billion in principal and $72 billion in interest that they owe. And it doesn't look like they're going to get out, but there is a way with the public bank, as we'll see a little bit later. So liquidity rules now say that you can't, the banks can't buy municipal bonds anymore. They used to be able to do that as part of their Tier 1 capital. They can't do that anymore. So now what could happen is that the states might not be able to sell their bonds, which means the interest rates will go up. I don't know if we're going to approach Greece levels, but California actually did during the crisis. It was about the same level as Greece. So it hasn't happened in New York, but it could happen pretty quickly if we all have another downturn, and we probably will at some point. So again, this refrain that we don't have any money, that we have to cut spending, we have to raise taxes, borrow money, or sell off public assets, we all know this already. So basically now we're stuck with this problem. So what is the solution? Well, the solution is to own a public bank. So, okay, part two now. Why a bank? Well, banks, when they make loans, and here's part of another slideshow, when they make loans, they basically create money. I don't mean they make profits, I mean they actually literally create money on a computer screen. And people who don't believe this should listen to the Bank of England, because that's how they put it. I'm going to quote now: the banks do not act as simply as intermediaries lending out deposits that savers have placed with them, nor do they multiply up central bank money to create new loans and deposits. Commercial banks create money in the form of bank deposits by making new loans. So this comes from the quarterly bulletin in 2014, first quarter of the Bank of England, and they're saying it flat out, what honest bankers have been saying for a long time, and economists who know this, that the money is literally created when the loan is made. Now, I don't mean to say that a bank can just wake up tomorrow and decide that they're going to create money. They have to have something called collateral. But as we've seen, the collateral can be overestimated. And in fact, it was in the last housing crisis. A lot of the appraisers were actually paid to overestimate the value of the house and actually the land under it. So that the appraisers who didn't go along were actually fired. And about, according to Bill Black, about 3,000 or 4,000 of them put their signatures to a petition saying that, hey, we've been pressured to raise the appraisals, and you know, we don't want to do this, it's dishonest. And basically they sent it to everybody they could, and they were ignored. So why would the banks do this, knowing that it's basically fraud and that they are inflating the value of a home beyond what it's worth? Well, they sell off these loans, they securitize them, they bundle them up, and they sell them off to other investors, and they don't tell those investors that they've inflated the value. So basically what they've done is they've committed fraud. And there was a point, according to Bill Black again, where 90% of the no-doc loans, as they were called, meaning there was no documentation by the borrower, they were fraudulent. Either the borrower's assets were inflated, or the value of the or their job prospects were inflated or something, and the value of the house was inflated as well. So these are fraudulent loans. They were made by the banks because they get a bigger fee as a commission when they sell these things off to other investors. So that's their incentive. But we have an incentive to have honest loans. And a public bank like the Bank of North Dakota would not securitize its loans. It would keep the loans on its books, and therefore they would have skin in the game, and it would be against their own interest to inflate the value of homes. Okay, so let's see a little bit more of how this works. So on the top you have the current system, and this is for the from the Center for the Study of Innovation, which is a public bank promoting agents, NGO actually. And so on the top you have the current system, which basically takes money from the taxpayer, it puts it into the state government. The state government puts money into Wall Street through investments. They get a little bit of return if it's in a bank, you know, they get interest. I mean, now it's very low, you know this yourself, it's probably less than 1%. And then Wall Street does what it does stock markets, it goes into currency manipulation, it goes into derivatives, which we'll see later is in the tens of trillions or even hundreds of trillions of dollars. And then if they're profitable, that profit goes back to Wall Street, doesn't go back into the state except for the tiny little interest. So that's the current system, and we know that when Wall Street crashes and the banks crash, they basically look for a bailout, and so then more government money has to go to them. And as we're going to see later, this is going to happen again, and it's going to be worse because of the new rules that were supposed to have helped us but aren't. So now the different system is the state bank system. So what happens there is you take the revenue and you put it in the government, and the government puts it into a public bank. Now it could be a city bank also. You could substitute the word state. You can put city in there if you have a big enough township like New York City. You could have a city bank. We could have one for Manhattan, one for Brooklyn, and any kind of borough like that. That's actually bigger than North Dakota, each of the boroughs. So we could certainly do a city bank or a borough bank. And maybe Orange County could do its own bank as well. So I'm going to talk a little more about Orange County a little bit later, but basically what happens is you now have the money in the state bank, they collect all the tax revenues, this is what North Dakota does, and then they can put the money either into state projects, as you see from the upward arrow, and local needs, or using their leverage, the community banks come to them, and the community banks can say, hey, we'd like to start this business, we don't quite have enough assets, can you back our loan? And then the state bank can back the loan of the community banks. And we're going to see in a short while why the community banks are so essential for communities to thrive and survive. And the big banks simply cannot do the job and don't want to do the job of the loaning to communities. Okay, so that's how the two systems compare. So now let's look a little more at that community bank. And I like to look at this a little bit differently. Perhaps than just as a public banking story. It's also a community bank story. So I'm going to talk about that a little bit. So what happens is that in states like North Dakota, which is the blue line on the top, they actually have a loan-to-asset ratio. That's how banks measure how much they're lending. That's about 75%. That's actually going to be on the next slide, but you can see here there's a loan per capita rate. So North Dakota is up on the top. The neighboring states are not that far off, but they're all lower. And then that line on the bottom is the U.S. as a whole. So a loan per capita ratio for the United States was $3,000, whereas for North Dakota as of 2010, it was over $12,000, and it's probably more than that now. So what's happening is that North Dakota is actually lending money. So their community banks are doing what we all think banks should do. They're lending money into the community, they're building businesses, helping people get mortgages, and we'll see a little bit how that helps the state. So now, again, this is a loan-to-asset ratio. Now you can see, again, the top line is North Dakota, which has a 75% loan-to-asset ratio, even in 2009 when everything was collapsing. They sailed through it. They were the only state to have a surplus in that year. Montana came a little close to it, and the next year they had a surplus, but every other state was in deficit for that year in 2008 to 2009, that fiscal year. And then, of course, everybody, the banks were failing left and right. Now I looked up the loan-to-asset ratio of J.P. Morgan just to get a comparison. That's this red box on the lower right here. So this is one of the what they call systemically important financial institutions, or SIFI, because they don't like to say too big to fail in the Federal Reserve. but it's the same group. So this SIFI has a loan-to-asset ratio of 31%. So that's less than half of what North Dakota is doing, and in fact less than half of most of these other states, but especially North Dakota. So they're basically not in the lending business. They're in the derivatives business and the merger business, the wealth management business. Lending, if they do it at all, they do it for big companies, you know, like General Electric or something. They're not going to be lending to, you know, people who need mortgages very much. They're not going to be starting small businesses, and over 95% of the businesses in the country are small businesses, meaning less than 100 people. So, you know, this is not their business, and we have to start to really think about this, because they call themselves a bank, but they're really a money management center, or a, I don't know what you want to call it. You can call it a SIFI or something, but it's not a bank in the Jimmy Stewart sense from that movie, It's a Wonderful Life. So that's what we'd like to think they are, but they aren't. Okay.
What is loan-to-asset ratio?
Yes.
What is loan-to-asset?
Oh, loan-to-asset just means if a bank has $1 billion and they loan out $750 million, that means that if 75% of their assets are going into loans. Now for J.P. Morgan, it's actually going to be, 69%, because 31% is going into loans. So 69% is something else other than loans. So it's in derivatives, or it's in proprietary trading, or you know, mergers or acquisitions are backing it somehow. Investments, yeah.
So the balance, the other 25% in North Dakota, is that their profit?
No, that's other things. They too have some securities, and they do some investments outside of lending, but it's more localized, and they might be doing state projects. They need some for overhead, so they have to keep some aside from that. But if you look at their annual statement, it's much less than J.P. Morgan, and actually that 31% comes from Value Line. I didn't even have to look that up. I just found the report that Value Line did on J.P. Morgan. So this is fairly consistent. I think it's a little bit less now. It's like 65% or something, or 60% maybe. But basically the community banks in North Dakota have a much higher lending rate. That's what they do with their money. They don't do all these other things that Wall Street is famous for. So we'll see a little more how that influences the community now.
And why is Montana and South Dakota so high? What are they doing so well that...
Well, I'm going to talk about that in this slide here. So now this is actually where the community banks operate. And so you can see that middle section, which is sort of dark blue, where North Dakota is and all those states around it. They have the highest community bank per capita ratios. So the small states, small population states, tend to have more community banks, and Maine and a couple of other outliers like that. So that's one reason. They're small states, so they have small banks, so they tend to be community banks. You get to New York, it tends to be only, it's only 21%, because all the big banks are located here. California is even worse. Now, if you look at this chart, you may notice right away that all the states that really had trouble, a lot of foreclosures and stuff, tend to be the states that have low percentage of community banks. So California, we all know that they had a subprime crisis. Florida, New York State had a crisis, not so much New York City, because that's an anomaly. But then, the mid-Atlantic states had some problems, the southern states had problems. All of these have low ratios of community banks. Now, North Dakota stands out as an exception. They have 81% community bank ratio. So it's higher than any other state, and the reason for that is the state bank backing the community banks. So they basically don't have any of these huge banks. There's no J.P. Morgan out there, there's no Bank of America. It's basically the Bank of North Dakota and then all the community banks around them. Now what that does is it ensures that the foreclosure rate, as I just said, is actually very low. So you look at the 5 worst states, as I said in the other map. The worst state is Florida. So 1 in 346 homes had a foreclosure. It's extremely high. And then Nevada's not far behind. And then Nevada is a small state, so you'd think maybe they have community banks, but in this case they don't. If you look back on the previous slide, that's actually got a low ratio, very low. It's like, 8%. So that's, again, where there are very few community banks and a very high number of foreclosures. So again, the pattern is pretty consistent. One in 543 in Maryland, and then Illinois is bad, and New Jersey is bad. Now the best states, are those mid-plain states basically, except for Vermont is also good. I don't know what the story is on Mississippi. That's pretty good too. But you can see North Dakota has one in 106,489. Homes are foreclosed upon, which is 4 times better than Vermont, which is the next best state. So obviously it's a dramatic difference. So the big difference is that they have this big state bank backing all their community banks, and their community banks are lending in the state. They're not securitizing either. So all of those loans that they make, they're darn careful to make sure that they're good loans and they're conservatively made. And they're not going to sell them off for a fee and try to fool somebody. If they take a loss, they take a loss. And the same goes for the state bank. I remember I went to the first Public Banking Institute symposium, and the vice president of the Bank of North Dakota was speaking there. He was the vice president for 10 years. And he said, well, you better be darn careful with the state's money, because if you lose it, if you make a bad loan, if you lose it, it's gone forever. So, you have to manage it very carefully. I should say this is not a panacea, but if you are managing the state's money, you're going to be much more careful than if you're securitizing some bundle of money and selling it off to somebody. All right, so we know now that the small banks, the community banks, are the best thing for communities. Now, what's happening to them? Well, unfortunately, they're disappearing. So this is what's happening. You see the top blue line is actually all the banks with less than 100 million in assets. You can see there's a sharp decline there. It's gone down from 13,000 in 1985 down to only 2,600 in 2010, and it continues to go down the last 4 years. And then the next tier is that light blue line is kind of held steady. As you get more assets, it's going up. But the one line you can't even see on this chart is a very thin red line on the bottom. But actually, these are banks with more than $10 billion in assets, and they've tripled since 1985 to 2010. They've gone from 36 to 107. So you can see that that's where all the money is going. So we're losing the best banks for the community. And now this chart tells you a little more about what's happening on the money side of it. So the total assets of non-community banks have grown much faster than the community banks since the early 1990s. That's the red line on the top. And this actually understates it a bit, because this chart only goes up to 2010, so it's only like 1 year after the crisis. If you carry it out to 2014, you'd see a similar escalation to what you have in the beginning here. It would start going up again. So what's happened is that the small community banks are being just pummeled by these large banks which don't make loans. So, in a recent issue of American Banker magazine, they call the community banking model not sustainable. So this is a pro-bank magazine, and they're saying flat out that this is not a sustainable model. In other words, we're going to lose all the community banks and the small banks that actually benefit people. So this is another chart that shows you very clearly the sharp decline in the number of banks. This is from American Banker magazine also. So you see the number of banks with $100 million or less in assets is just going away. And this only goes to the third quarter of 2013, so you can just continue that another year. And Sherrod Brown, who's a senator, he was testifying on ABC's this week, and he said 15 years ago the assets of the 6 largest banks in this country totaled 17% of GDP. Now the 6 largest banks in the United States total 63% of GDP. Wow. So this is 2010, so let's just knock that up to 2/3, because it's been increasing since then. So the 25 domestically chartered banks in the country control about 2/3 of all assets held by domestically chartered banks, and really it's the big 6. And there were 2,118 banks with $100 million as of September 2013, down from 3,000 at the end of 2008. So just in, 5 years, we've gone down by almost a third in the small banks, and we know that they benefit the community. So what are these big banks? I apologize for the tiny type, but this is how it came out of the report. What are these big banks doing with the bulk of their assets? Now, this is a report from the Office of the Comptroller of the Currency, and that's the closest thing you have to a organization that actually tracks what banks do. And so this is a derivatives chart. Now, the thing you have to know about this chart is every number you see here, as big as they are, you got to add 6 zeros to it. This is in millions. So therefore, this number here, this total derivatives for J.P. Morgan alone on the top line, this is actually $71 trillion. That's what they have, this one bank, in derivatives. Their total credit exposure, even if you take out the hedges where one thing goes down, the other thing goes up, and you allow for the fact that there's other investors, it's not all the bank's money, they're like holding it for other investors, and we can judge how safe that is. But they're holding it for other investors. Even if you take that out, they still have a 205% credit exposure to capital, which means it's twice their capital assets are exposed in derivatives. So, if half of the derivatives go bad, they've lost all their capital. But really, if even 5% of the derivatives go bad, it's going to wipe out so much of their assets. They're going to shut down all lending and have to scramble to pay the derivatives. Because remember, a bank doesn't keep all that money in a vault. They have assets. Their loans are assets, so that if the loans can't get paid back, then they have to write down those loans. They've lost assets. Then they have to go in and see what they have, physically on deposit. I'm going to get to that a little more later, because where they're going to look for assets is going to be pretty shocking. But basically what's going to happen is that they're going to look to replace those assets from some other source, and they're not going to have it in their own bank. Because J.P. Morgan is only, if you look at the asset size, it's only a $2 trillion bank. And that's the biggest one. So here we have these banks which are making these incredibly dangerous and speculative and almost unregulated bets with money that actually eclipses the GDP of the world. I mean that quite literally. The world GDP is about 70 trillion, and so if just one bank has that, you can quickly see it's well beyond that. And mostly it's in these top 6 banks. You see they all have more than 100% credit exposure, and Goldman Sachs is the worst, with 719 times their percentage times their capital. So this is what they're doing. And we know that when the market takes a hit, all of these derivatives are going to come due, and nobody's going to be able to pay them. And we've been through this before. And now the derivatives market's even bigger than the last time. So the total size, in case you like to count these things, is as high as $1.2 quadrillion. So I used to think quadrillion was a number reserved for astronomy, but I guess it's now for bankers as well. Okay, so what happens if they go bust? Well, we saw a little preview of this in Cyprus. You may remember that they confiscated depositors' money. So this is what they're planning to do too, because now Dodd-Frank says no more bailouts. Mm-hmm. So that sounds good on the surface, but that doesn't mean that the problem has gone away. It just means that the banks won't get bailed out. So now we have something called bail-in, which means basically you wake up one morning, or state wakes up one morning, usually after a weekend, and whoops, suddenly your deposits are gone, and instead you've got equity in a failing bank. And you had no choice in the matter. It was just done overnight. It was done automatically. You go to the bank and you have X amount less than you had on Friday. In the case of Cyprus, some people lost as much as 75% of their deposits. So you could actually lose. You could lose it all. It could be 100%. There's no limit on this. I happened to be at a Minsky economic conference, and I asked an under Treasury Secretary, Undersecretary of the Treasury, about this, and I asked, well, this is a new plan, this bail, and is it true? And she said, well, it's complicated. So that's not exactly a denial, right? She said, well, this is a complicated thing, so well, it's being complicated. Our deposits are all at risk. This is another chart, and this shows you it's about $300 trillion of derivative exposure. It's 297, but let's call it over 300 now. And the deposits at the commercial banks are only 10 trillion. That's 9,000 billion. And in case you're looking for the FDC to bail you out, don't look there because it's off the chart. There's this little tiny line down here. They only have 25 billion in insurance. So forget about the FDIC. That's not going to protect your assets or your state assets. And of course, if your state loses money, that means they have to shut everything down, and they're basically going to be bankrupt. And we came pretty close to that last time as well. So what do you do to get around that? Well, that's when the public bank comes in, because the public bank is not subject to FDIC rules. And the Bank of North Dakota is actually insured by the state. It's what's called a doing business as, a DBA. So the Bank of North Dakota is backed up by the assets of the state in the form of taxes, so that they don't have to put anything at risk. First of all, they're not in the derivatives market in this sense at all. They have a little bit, but it's much tinier and it's more manageable. That's part of that 25%. But it's much smaller and it's much less risky. And they're backed by the taxes of the state, which will keep coming in as long as people work and they pay their taxes. It's more predictable. Instead of this casino that we have now for the big banks. So, I call it a casino, but actually that's insulting to casinos. Because in a casino, you walk in, you put your money in the crap table, and if you lose, you lose, and if you lose all your money, you get thrown out of the casino, or at least you can't play anymore. What these banks are counting on is getting a new infusion of money every time they lose. So they're changing the rules. So I don't want to insult casinos by saying it's casino gambling, because that's not fair. So now I know that Orange County has a number of alternatives to the banks, because the banks are not supporting this sort of lending anymore, because now we've had these big banks taking over the businesses and the small banks are failing. So I know there's a business accelerator in Orange County. There's a couple of EDCs. There's Startup New York City, which is basically tax-free money for creating a business. And don't ask me how the state is balancing its books, but that's what Cuomo has put out there. But the fact that you're all in this room, and I assume that you know some business people as well, or maybe you're business people, means that it's not enough. So we know that there's all of these things have sprung up because there's not enough credit out there. So this is what a public bank is going to do. It's going to create credit from the state's money that it already has. So that's the new option, to create a state-owned bank. So it creates its own credit. By the way, I should have said up front, if you have any questions about the particular slide, raise your hand and I'll answer that. I want to answer more general questions at the end, though, because I may cover that. I hope I do if I do my job right. Okay, so what can we do? So North Dakota has a state-owned bank, and it creates its own credit. So what they can do is they can expand public services, they can lower their taxes, they can increase the bank's capital, which they did in the 1970s, to make even more credit available to the people of North Dakota, and they don't need a federal rescue. So, when there's a crisis in the rest of the country, they just keep going. Now, here's about where people start to say, well, it's an oil and gas story. And we're going to see a little bit more later why that's not true, but it's not that. You can think also of these other states like Alaska and Texas and even California or Montana, which is a smaller state. They have oil and gas, and they all have much higher unemployment rates. In Alaska, it's 7.1% in 2012. North Dakota was 3.1%. And also the oil and gas boom didn't really start until 2005, because that's when the fracking started. So it's not just coming from that. There's a lot that this state bank has done, because it goes back to 1919, and it was doing this, for decades before the oil and gas boom, but we'll see a little more about that too. So in 1991, the state legislature passed a $21 million budget for economic development. This is North Dakota, for the period 1991-93, and this amount was 4 times larger than any previous development budget, so the funds for this came from the Bank of North Dakota. And so this economic development package was part of a set of policies that was known as Growing North Dakota. And actually before this, they were actually losing per capita income until they really got aggressive, and they relied on the Bank of North Dakota to help sponsor their development program. So they were having trouble too, but then when they started really partnering up with the Bank of North Dakota, that turned around, and now they're doing much better. Okay, so now what does the Bank of North Dakota do as far as profits? How does it turn out? Well, they've had a 20% return on equity for the last 10 years, or actually a recent 10-year period, but it's pretty close to that still. And their profits were $300 million over that 10-year period. And remember, the bank is paying a dividend to the state. They're not paying interest because the state is basically the main shareholder, or almost the sole shareholder of the Bank of North Dakota. So it's much better to get a dividend from a bank than interest. Interest is minuscule. Dividend is like in a stock, you might get 2 or 3%. So they paid back $300 million to the state, which in a state of less than 700,000 people for most of that time is not so bad. So they reduced the tax burden on the taxpayer because of all this payout, and they're supporting public services. Sorry. In contrast, our tax dollars are going into Wall Street. Okay. So why not invest in state for education, higher education, renewable energy, tech startups? We can all think of things. Certainly infrastructure. I drove up here from Manhattan, and boy, do we need infrastructure. Practically swallowed my car in some of these potholes. So those are some of our choices. Now, another advantage of a public bank is that they have minimal operating costs. So there are no bonuses, no bankers' bonuses, no big fees, no big commissions, no high-paid CEOs, no need for buildings except for the main branch. The Bank of North Dakota is literally one building. They have no other branches because they use the community banks to service the state. They have no tellers. They have no bank machines also. They don't need to advertise because the state knows where it is. It's right down the street. So it's easy to maintain and very cheap. All right. Now, about the ratings and the staffing, a little more about that. S&P rated North Dakota's bank. They gave them basically the same rating that New York State has, which is a AA minus. And short-term credit rating of A minus, 1+. Don't ask me why they do these things, but those are one of the high ratings. It's a funny way of noting it, but that's what they do at S&P. And so that's basically the same rating as New York State has, and we're one of the better states, and way above California, which is a C rating like Greece. I think it's a little better now. So, of course, you have to ask yourself if those rating agencies are reliable and how good are they at predicting when things are going to go south. But in any case, we're rated as well as the Bank of North Dakota. Now, another risk, sometimes people say is, well, we have Jamie Dimon, isn't he a great banker? And, we can't afford to pay him the $20 million that he makes a year. Well, maybe that's not such a bad thing. The president of the Bank of North Dakota makes $300,000 a year. And the Bank of North Dakota has had no scandals and no fines and no, findings of fraud or anything, or any civil fines in its almost 100-year history. And in 2012 alone, J.P. Morgan had paid $20 billion in fines. So, to idolize Jamie Dimon, who's running up all these charges, and these are just the things they're finding, and they're actually finding, to idolize him as this great banker, I think might be a little bit misplaced. So I used Potter here from the Jimmy Stewart It's a Wonderful Life movie, because that's reminding me of Jamie Dimon. Okay. So now this is about where people start to say, well, all right, we want to do this bank, now how do we do it? There's actually a number of ways you can get the initial funding. In North Dakota, what they did is they floated a bond issue in 1919, and they had a nonpartisan league that whipped up a lot of support among the farmers. They literally had no banks in the state. They had to go to next door to Minnesota to do their banking, so the farmers didn't like that, so they said, let's get our own bank. So they created this bank out of a bond issue. That's one way to do it. But of course, when you float a bond issue, that means you're incurring more debt. Fortunately, now we have other ways to do this. And I'm going to talk about number one a little more, but basically this is out of the Washington, well, it's actually Seattle Public Bank Coalition, because now we're getting, in Public Banking Institute, we're getting so much interest that we're getting down to the city level. We have a good council member out there, and Walt's going to talk about this later. But basically, we're trying to get public bank in Tacoma, and I think in Seattle, and maybe other cities in Washington. They have put this out, and they have a good website, and this is all from their website. So they say that you can have equity investments and non-voting shares. You can transfer some of the city and state deposits because they all deposit at a bank. Instead of putting it in a commercial bank, you put it in a public bank. You can have short-term or medium-term debt. That's basically, it could be a bond, or it could just be funds that the city or state treasurer has. They all have these rainy day funds. I'll talk about that too, but you can reinvest those. You could do a CD that could be sold to the treasurer and other outside investors. And this is perhaps a little controversial, because then you bring in outside investors. Well, how much control of the public bank are they going to have? But okay, this is one option. I don't even know what number 6 is, so I'm not going to talk about that. But there's other things you can do. So this is just 7 ways that you can fund a bank initially. But remember, as it goes along, you're getting tax dollars in the bank. So once, all you have to do is fund it up the first time, and once it's up and running, once you've kick-started it, then the taxes take care of the rest of it. What's going on in New York if we wanted to do this? Let's get a little more specific here. So I looked up the what's called the Comprehensive Annual Financial Reports. Now, most people don't even know these exist because they're used to hearing about the budget, but this is actually a more important report. These are the reports of all the assets of the state or the municipality. So what this is much, first of all, it's much larger, because if you think of it, the budget is just the budget for the year. It's what's coming in and what's going out for the year. The assets means everything the state owns, including all the fixed capital, which we don't have to care about because we can't invest that, but also all the liquid investments, including the pension funds, or retirement funds for firefighters and police, and various investment funds, rainy day funds, all kinds of things. So I looked at the state fiduciary net position, which means all their liquid assets, not counting fixed capital, for the state. It's $181 billion right now. And it's $192 billion in New York City. And I looked at Orange County as well, and it's $135 million. Well, smaller out here, but you still have the $135 million. That means approximate, actually. That's a tilde, not a minus. Don't worry, you're not negative. So you do have, as of the end of 2013, $135 million in liquid assets. And if you really go through all the CAFRs, the estimates vary, but there's approximately 200,000 of these CAFRs. If you look at all the little agencies and all the enterprise agencies, all the little firefighter funds and little towns and everything, you add it up nationwide, it's about 200,000 of these. So if you do that for New York State, you'll get tens of billions of dollars more. So now try to imagine you take 10% of these liquid funds and you put it into a public bank. Well, that's pretty good. I mean, then you're going to have basically almost a $40 billion bank, just from the top 2 alone. If you start getting into the smaller funds, it'll be even more. But that's plenty. That's the Bank of North Dakota is a $6.9 billion by asset bank. So if we had a $40 billion bank in New York, using the kind of leverage that a bank can use, we'd be in much better shape. We have all kinds of possibilities. So it's not quite a money tree. I don't mean to say that you can just reach out and pluck the money, because you do have to make returns and people are depending on that money. But here's the funny thing about the pension funds, because I don't want to imply for a minute that I'm saying we're not going to pay pensioners. That's not what I'm saying at all. In fact, I want to make it more secure. But they actually pay net of contribution from the employer and the employee. In other words, employees pay something into it every year. So net of that, they actually pay out about 2%, maybe 3% of their assets on a yearly basis, which means about 97% of that fund stays right where it is, invested year after year, hopefully making a profit, so that they can pay the future payments to the pensioners. But the point is that there's this huge pots of money. They're not really investing in the community. They're mostly on Wall Street and they're in big banks. They're in mutual funds. I've looked at these reports and they go on page after page. They're incredibly diversified, but they're over-diversified in basically stocks and bonds and mutual funds and things like that. So if we took 10% of that and we put it into a public bank, well, first of all, you're better diversified. Second of all, it's counter-cyclical, so that if other things go down, maybe the public bank won't. It shouldn't, actually. And third, you're investing in the community, which has its own returns because of all the investments a public bank can do. So instead of investing in China or investing in shorts or investing in options or doing all these kooky things or derivatives, this is money that's right here in the community being used for people right here. So that's you got to factor that in too in the total return. Okay, so now what's going on in the country? Walt's going to talk about this a little bit more later, but there's basically 20 bills in 15 states right now for some kind of state banking legislation, and you can see on the map there's actually 1.5 public banks. The half is the public bank for the Chickasaw Nation. They have something called Bank 2, because Bank 1 didn't work, but Bank 2 is working. And Bank 2 takes all of their assets, and it's in a public bank. And so they support the Chickasaw Nation and all of their enterprises through that public bank. So it works pretty much like the Bank of North Dakota, except that it's just for those for that independent tribe, which is really its own nation. And so you got Philadelphia, Santa Fe, and Seattle, and a few other places which are looking at public banks. And so the question is, isn't that a better solution to reallocate some money into that instead of the way we're doing? So it'll free up funds. It'll give you a window into the Fed. Now remember, the Bank of North Dakota has its own Fed window, which means they get the lowest possible interest rates from the Fed when they do borrow from the Federal Reserve that is possible to get. So they're like all the big banks, they have this special window. So if a public bank in New York had that as well, then they would also get the lowest rates. And the states and municipal governments, of course, don't have that. They have to borrow at market rates, which are way, way higher. It could be 5%. It was 7% for, actually 9% for California at one point. So they have to create, the states have to create large rainy day funds that the public money sits in and earning little interest. By the way, there's a 71, Ellen Brown found this, there's a $71 billion treasurer's fund in California, which is a rainy day fund. And she actually got to ask the treasurer, well, how come you can't put that into the debt and, maybe pay for some things in California? He said, no, you can't do that by law. It's restricted, and what it's restricted to is whatever the treasurer wants it to be restricted to. But people will say, well, it's illegal and so forth. Laws are made to be overturned, and we make new laws. So if there's enough public demand, we can perhaps overturn this, and we can make a new law, and then use that money for a public bank. And I'm going to get into how we do that a little bit later. But that's what we're aiming for. Okay. So why a public bank? Level the playing field, get the rates down, the overnight Fed rate, I just talked about that, to 0.2%, which is what it is now. And I talked about how high the state borrowing cost is. And I talked about California borrowing at 9%. So also Dodd-Frank has made it harder for community banks to follow the rules, because Dodd-Frank has so many rules that actually I don't even want to say ironically, because the big banks actually wrote most of these rules, but it's working against the little banks. It would be ironic if it was intended not to work against them, but I think the big banks did intend it to work against them. So now one of the things the state bank can do is it can actually help the little banks, the community banks, comply with the Dodd-Frank rules, because this is what the Bank of North Dakota does. So they can help these community banks comply with the rules and be able to continue to make loans. Okay. So another thing that a public bank can do is it can control rising credit costs. The states are now hit with lower credit rating, making borrowing more expensive. California was rated BBB. It went down to C at some point. And it was like Greece, and our credit rating is AA, as I said before. So we need not only credit, we need affordable credit. And now, as I mentioned earlier, you know, the municipalities can issue bonds, but that means they're sold in the open market. And now the banks aren't allowed to buy them for Tier 1 capital, which means there's less purchasers, and so our interest rates are going to go up in order to attract other purchasers, which means we have to pay more in interest, and that becomes a, you know, it can become a death spiral. We have to pay more, we have to borrow more, and eventually we can't afford it. So instead we can float our own credit. By the way, usury was considered anything over 8%. If you go back to Old English law, going back to 1545 England, and people were hanged for that kind of thing, but now it's apparently normal for a credit card. And then some. So now banks are becoming, public banks are becoming more and more popular. It's actually 40% of the banks in the world that are public banks. So these are a couple of international examples. The Bank of India is the biggest public bank in the world by number of branches. China basically has a public bank. Japan has Japan Post Bank, and the Bank of Japan also, which operate more in the public interest. So we don't quite have that. We have a Federal Reserve, which is basically a overseer of all the commercial banks, and as you get down to the member banks, it's really all private banks. So that's one reason we can't count on them for any kind of assistance. So what can be done here? All right, so let's get into how do we actually get this going. So again, the old familiar refrain: raise taxes, cut services, borrow money, sell assets, or invest in our own citizens by creating a public bank. So what are the next steps? Well, we can pass a resolution to return to prosperity by forming a state-owned bank. And I'm going to talk about how you can tell your state representative, and this is where your homework is going to come in, and how you can get them to get on board with this and find and get them to sign on. And I'll talk about specific bills in a moment. And you can also find natural allies. All right, let me go through that. All right, so here are some natural allies, including all of you in this room, and all the organizations that Tula mentioned before. They're down on the bottom here. So we also want to get union leaders. We want to get teachers. We want to get business people. We want to get just plain folks, and everybody who wants to get involved in this. Of course, we want to encourage them, but we also need to get community leaders, civic leaders, and of course all important representatives to get behind this. Okay, so now what do we do? Well, first of all, you can download this slideshow, and I know this is a lot to take in one day, so I'm not expecting you to memorize all this. I'm going to cross the Rubicon just a little bit here to point out this little tear-off sheet. If you take one of these little tabs, this actually gives you the URL of the slideshow. So, it's very old-fashioned technology, but basically it's all on there. So you can type in the URL, and you can get the slideshow. It's up on slideshare.net, and you can view it. You can download it. It'll also give you my version here, which I'm reading from, which has all the comments in it. So there's actually two slideshows up there. There's one without comments, which you're seeing, and then this one that I'm reading from. That's in that's in the second item here, but it's on the tear out. And then you can also join the Public Banking Institute a Google group. It's on the top here. You can join a volunteer group as well, which is mostly for real activist volunteers. The other group is sort of for discussion of ideas and, how to create a public bank, but it's not quite so hands-on. And then I set up a Facebook page for public banking, so basically it's for New York public banking. These numbers are a bit old, it's higher than that now. All of these memberships are about 20% higher. And my acronym for this whole thing is Research, Approach, Petition, so RAP. So the first three things are research. You can begin a study of public banking in your community, Orange County or Goshen, and you can find out more about your specific assets and what the laws are, what you're allowed to invest, what you're allowed to repurpose, and so forth. Then when you've got all that, hold a press conference or public event. I was in a press conference with Sandy Galiff because she's the sponsor of the study bill for New York State, and we had a press conference in Albany about that, and you can actually see that up on Vimeo as well. There were some other people in that, not just me. And you can set up a petition, which I did already, to support the two public banking bills for the state, one in the Assembly, one in the Senate. They're actually the same bill, but they're just in different houses. And try to get more signatures on those. And you've got the URL for that here. So if we got 1,000 signatures on that and we hand-delivered them to the sponsors, I think it would make a big difference. We have about a third of that right now. You can petition your assembly member, and the next slide's going to go into that a little more. But this is where you all come in. Because I can't do it from New York City, number one, I just physically can't do it. But number two, a constituent petitioning their own assembly member, or own senator, is obviously much more effective than some New York guy, who's from the lefty city down there. So you're all up here. You can start a movement in Orange County and really get your local legislators to support this. And here's the members of the banking committee. So these are the most important people to reach, especially the chair. Now all the people in red, I've actually visited either alone or actually with other people in the public banking group for New York, and we try to get them on. The people in green actually did get on. So this is just for the assembly bill. So Walter Mosley, he's in the banking committee, he signed on as a co-sponsor. Down in the lower part, in the non-banking group, the other co-sponsors are Linda Rosenthal, Dan Court, Mosley's in there twice, but we basically have 10 co-sponsors at this point, and we have about 3 in the Senate version. So 10 in the Assembly and about 3 in the Senate version. Is that it? So there should be another slide there, but there's not. Well, there's supposed to be another slide there, but basically yeah, okay, so basically that shows you the bill. And the bill, I have these resolutions which were also out on the table when you come in, and I have 2 versions of them. I have one for the legislator and one for the citizen, and this gives you the basic rundown in summary form of why you should support a public bank. And if you're a municipal leader, you sign on the bottom, and that indicates your support as a municipal official. If you're a citizen or a business owner, there's a different form, but basically it's the same reasoning. It's just your signature is a little bit different. Now, what I would like to get is to collect the whole pile of this. So if you can scan it and email it back to me, or maybe to give it to Tula and she can gather them up, then perhaps when we get enough of these, we get a few hundred of these, then we can have a stack, and I can go to the sponsor of this, or maybe even Annette Robinson, because I'm still trying to get her on board. And I can say, here, these are all the legislators and these are all the business people and so forth in the state, and they all support a public bank. Now, would you please address this? We have to get the numbers up. It's not enough to make it a logical case. It's not enough to sit here and say, well, we all agree with this. We have to really get the grassroots support, and we have to get the council members and the assembly members of the counties and get them all to support this until we have enough support to really pass this study bill, and then hopefully we can go beyond that. Okay, so I also, let's see, I think that's about it. So this is actually only the beginning, that's what I was trying to say here. And it's up to you now. So I will take some Q&A, but then I want to introduce Walt and Joan, and then we're all going to sit up at this table.
Board of the Public Banking Institute and one of the founding members of the Pennsylvania Project, and the current Director of Communications for PBI. This is a volunteer effort that's happened around the country and growing dramatically in the last couple of years. I really want to acknowledge Scott for the really thorough and almost head-swimming sort of amount of data that he put into the space today. Really, I think, enormously helpful. I've seen it all before, but it really always helps to make clear what we've got to work with and what the stark, dramatic difference is between living inside the existing world of big bankerdom and what that means to us in terms of our well-being, our commonwealth, and our democracy, which is perhaps the biggest issue that is in the room here. So again, Scott, thank you so much. Scott has done some really important work for us around the country in looking at what cities actually have in store in terms of their consolidated annual financial reports. As you know, the illusion, or the delusion actually, that citizens have that communities are broke, that our cities, we have any money, and we have no prospect because they can't do anything because, well, actually in Philadelphia, where Scott did some, evaluated those CAFRs, even though the city was broken, they closed down 23 schools and fired a couple of thousand teachers. The city has, Scott discovered, has $12 billion in assets. They have 40,000 vacant properties. They've got all kinds of needs in, like every city in America, and they have all of this money, and it's all sitting in the bank, basically in the Wall Street banks, being invested in places like Brunei and foreign currencies. In fact, in the case of Philadelphia, they had $1 billion invested in foreign currencies, which means that the money isn't invested in Philadelphia. It's not invested in Pennsylvania. It's not even invested in the United States. And the city pays hundreds of millions of dollars, as most cities, big cities do, for management of these funds, for pitiful returns on the most part. Scott has also illustrated this, so Scott's really the man. That's a very important component of the overall national plan to an effort to create public banks. I'd like to just talk a little bit about the big picture and then bring it down to y'all, bring it down to all of us, I should say. Because we get very caught up into an unexamined relationship with banking. It's a bit of a sacrosanct, sort of a mysterious area. It is the Wizard of Oz sort of character, where his power is behind a curtain and it makes a lot of noise and it runs everything, or it looks like it, and actually in this case it does. And the language and the technology is all very obscure. This is a very mysterious thing. We're in the banker's hands. We just have to do what we're told and come up with what they need. So what that allows them to do is to separate us from our inherent, our sovereign right to have our own money and to create money. So we have abrogated our sovereign ability to create money and credit into our community, as has been done in places all over the world, certainly in the United States. Back before the Revolutionary War, we did that. The Quakers did it very successfully. America was fat and happy. The colonists were doing really well. And then Franklin spilled the beans when he went to England. And they said, "How's it going in America?" They said, "You won't find a happier species on the planet of the earth than the American colonists." Oh, why is that? Well, because we give people credit. They start their businesses, they start their families, and everything is going on very nicely. The king and Rothschild, his patron, said, no, wait a minute. You make your own money? You can't do that. you have to get your money from us, and you'll pay us for your money. If you're gonna get money, credit into your system, you're gonna have to get it from us. Well, this is the elephant in our room. This is the elephant in our room. We have abrogated the opportunity for us to create credit for our communities and for our country. And we've given it over to a handful, a relative handful of individuals who now wield that power to their own interests, and as we've seen, are continue to consolidate the power into fewer and fewer hands as corporations and bankers align with governments all over the world and international banking cartels that are basically overseeing what's going on here. So part of the big picture, before I talk about what's going on with public banking in the country, but part of the big picture I want you to get is that we are trapped at the moment in this myth, in this institutionalized deception that we don't have any way, that we have no power here. Now, this thing in Congress that happened this week is a perfect example. And perhaps if you guys haven't listened to Elizabeth Warren's 10-minute diatribe, monologue about the collusion and cohabitation of Citigroup and the United States government, all branches of government, and the people who are in the House and the Senate, you get just one example of what's happened in the last couple of months. So, for example, the G20 last month decided that institutionalized that not only will they bail out in your deposits and your city money, but now they'll take your pensions as well. Anything they can get their hands on, which is what this last little deal with Dodd-Frank was about, was putting the derivatives back into our hands. Well, any way you look at it, we're going to get, our prospects are dimming, frankly. Now, I don't mean to be alarmist about it, but I really think that when you look at what's going on about the consolidation of power, the undemocratic consolidation of power, with the Bank of International Settlements, which is the global bankers all working together with policies and establishing themselves as the authorities and the advisors for what can be done. They've done this without anybody's approval, without ratification on a treaty sort of a basis, without support of the Congress or review of the people. Now, it's a grim picture, but it's germane here, because when we talk about public banking, what we're attempting to do is something revolutionary, at least revolutionary in this country, because as Franklin later said, it was the refusal of the king to allow the colonists to have their own currency that started the Revolutionary War. It was because the people were suffering at the hands of the oligarchy, and that they had no recourse, no place to go, no promise. That sounds like America, 2014. So there's an urgency to this, to understanding how public banking plays into our common history and our common wealth. We do have common wealth. We have assets. They belong to us. They don't belong to the bankers. We don't need to have all of our money come from somebody at huge expense. We don't need to pay twice what we need to spend for bridges. We don't need to sacrifice the educational needs or the housing needs and the security needs. So, we don't need to put up with this. Now, with all respect, and I totally appreciate the reality that we don't have much force in our democracy now in terms of people. Any way you look at it, quote unquote, they have the money, but we do have the votes. So we have to reconstitute it. Yes, in the past those votes have meant, and demonstrably have meant nothing. But that's not the future. In the past, it's made a difference. And I think that is our only hope, y'all. I really think that we have to insist on reclaiming the rights that we have to our own wealth, to our ability to create our money, and to protect ourselves from being mere pawns and feudal enslaved by a banking system that is not responsive and doesn't care about any of our interests. I was telling Joan, I've kind of been wrestling with, and Ellen and I are going to be doing the show this week, is going to include the discussion of what has the trend been in the last 10 years around banking, how the consolidation of power has gotten outrageously, more intense and more carefully devised, because there is a trend underway. And as they take over, run our government, they can do what they want, and they do. So they have the police and the army and the banks, and what else do you need, Well, we've got to stop that. Now, where can we stop it? Well, we thought at the Public Banking Institute that initially we would go for state initiatives, and we did, and there were over 20 states that were involved, and still there's still state level initiatives. But we realized that the bankers who have more impact at the state level than they do at the local level. America was always a group of communities of people working together and standing in and knowing their bankers, knowing their elected representatives. They were able to do everything from, get loans locally to shaming the local people for behaving or being crooks. We don't put them in stocks anymore, but there was that level of personal relationship. And money essentially is about relationship. It's about trust and relationship between one another. It's the fluid that we use to make things happen. It's a critical thing for us. So for us to be deprived of it is unacceptable and of course unsustainable, because none of us have futures, or so many of us don't have futures anymore, even though we've had some glorious pasts. So the local approach to creating public banks includes a lot of steps that, first of all, includes education. You need to find out how this works. It's not terribly difficult. It's basically, but the magic of banking and what's different about a development authority, for example, where a municipality or a business might be able to get funding, the difference between that and a bank is that once you borrow the money out of a fund, that's, let's say in the case of New Jersey, there's a fund called the Sandy Relief Fund, or something like $250 million set aside for the next big hurricane to come through that state. Well, when that fund goes down, when they spend $100,000 on the $100 million on the next thing, it's down to 150, and below that, it just goes down. If you have your own bank and you put that money in a bank, and you have $250 million, theoretically, by bank practice and by law, you're able to generate $2.5 billion worth of credit based on proper bank procedure and law and so forth. So there's an enormous difference between having your own bank and having to borrow your money, because you actually generate your own money, within good practice and safe, responsible practices. So that's the tool, that's the device that the public banking initiative is meaning to contribute to America in 2015, which is rapidly, going into history in a most unfortunate way. So the trend is well established. We see it. We have to act. So education of yourself is one of the things, and it is, as this gentleman in the back mentioned, it's time for a new economy. There is a whole new sense of what money can be when you look at wanting to have a sustainable economy. Money is a utility. It's not really a commodity to be acquired and collected and to identify yourself with and who you think you are. It is something that enables people to make things happen. So as a utility, then it should be managed like other utilities, and the local governments can be responsible for that. Now, obviously, in the course of creating a public bank, you have to separate politics from the management of a bank. A bank is a professional organization. It needs to be sustainable. It needs to make some sort of a profit, which of course, in the case of a public bank, goes back to your own interests. So, but that's not a problem. Banking has been done very well and responsibly for lots of years, and there are probably a lot of unemployed bankers that we can hire and find to help man and staff a public bank all over the country. So, as the learning part of this new economy, the denominators, what are the values, what are we trying to create, are different. They're not about putting our money where it will make the most dollar profits. It's about investing in ourselves where the values will be realized in terms of the quality of life, the safety of our systems, the education of our children, the ability to respond to emergencies, to do a variety of things that we haven't been able to do because there has been no money. And that's really, you know, there are geniuses in every community. There are people hardworking who are energetic and really want to make a difference and could have long ago, but the only thing that was missing is the money. That's what a public bank can allow or can do. If you create a public bank with a mission, every public bank needs to have its own mission, but the mission can be defined by the community. So if you want to stimulate small business, or maybe you'd like to support green energy, or maybe you'd like to provide low interest loans for small businesses, as they do in North Dakota. If you're starting a small business and you're a credible person and your business plan makes sense, you know, you can get a 1% loan for 5 years. I mean, really, this is where the growth in unemployment is. You know, or I'm sorry, where the growth in employment is, comes from small businesses. So the new economy is really, it doesn't focus in the global economy and attempt to try to make us competitive once again in a marketplace that far exceeds our ability, interest even, but it's an economy that's based locally, that looks anew at what are the possibilities of working together with the community resources that we've got. What are our assets here? Who do we have around? What needs to be done? So those would help to constitute what your mission would be for a public bank. So I'm going to, about new economy and education. The Public Banking Institute has just launched a new series of seminars, online seminars, and on phone conference seminars called the New Economy Academy. And when you become a member of the Public Banking Institute, which I hope you will do, as I say, this has been a volunteer effort for 3 years, professional people working all over the country. It's been an enormous success because of the need. But when you're a member, membership gives you free access to those things at whatever level you're able to contribute. And then on the website itself, Public Banking Institute has a lot of access to a lot of articles and videos and a variety of other things that you'll find very helpful to crystallize some of the stuff that Scott so generously gave us this morning. I'm just going to close my little portion here by telling a little story that of my travels this summer. I had the good fortune to go to the United Kingdom. And as I was driving, I stumbled across the Salisbury Cathedral. It was late in the afternoon, and a charming parking attendant said, "You're from America, aren't you? Listen, you're just in time. You've got 15 minutes to see the Magna Carta before it closes." I thought, my God, the Magna Carta, I had no idea. You know, I had no idea it was here, and so I got to, he said, "Well, park over here, that's where the staff is, you know, just run over to that building and you'll be able to get in." See, and sure enough. So I was taken in the moment because this public banking thing has pretty much taken over my life because of what it means for my fellow man, because this is, I think, strategically and politically a way that makes sense, perhaps the only way that will allow us to make a difference. But the Magna Carta was this stand as well. This was the stand of the people, even though they were nobles at the time, saying to the king, "Look, you need money for your wars, but you're not going to get any more stuff from us until you cut us into the deal and give us some benefits," which was written generally enough of a way to be applied to everybody. Well, what I noticed on the document or in the presentation was that it was signed on June 15th, 1215. So in June, it will be 800 years old. And the distinction between the possibility that people didn't have to live in feudalism and under the boot of controlling interest was established there. Our rights, and that distinction of who we are as people was made. So this is an important moment, but it's also a time to reflect on how we have not come all that far from that same situation where we are trapped by the powers that be unless we reassert ourselves. Public banking as an initiative, as a strategy, to me, I don't think it makes nothing makes more sense, because at least it gives us a chance to get hold of our money. And since money is what controls the government, I mean, you know, if you control the money, you control the government. That's been proven throughout history. Well, if we have our money and we can hold on to it, invest locally, we'll have a shot at controlling our future as well. So I really invite you to step up and realize also the urgency in doing so. Thank you for that, and Joan, I want to introduce Joan Bartle, who is an old friend and colleague in media and other things, but most importantly, she is a mover, somebody who has taken New Jersey and said, look, New Jersey, with all of its political machinations, needs us as well, and she is putting together an effort that I think she just was sharing. So, Joan?
Thank you. Do you need me to? Add my thanks to you for being here. I gotta tell you, it's all over. You know now, and you can't get away from this. I spent, as Scott introduced me, I have my business of managing credit card processing for businesses. I've been doing it for 22 years, and what I saw was the consolidation of banks, the elimination of the small banks, the changes with the credit cards being issued by these few banks, and then how they slowly raised the fees that the merchants pay, which means the cost that you pay for your products and for your way of life. So it's such, but I always just thought, well, that's, the way it is, that's the American way, and it's really okay. But I had this mystery about it, and then I found out about public banking. And it's just taken over a good deal of my interest and energy in putting together a program for New Jersey. When we started in New Jersey, we thought we could just do it locally. I live in a little town, Princeton, and I know a lot of people, and I talk to a lot of people. I talk to the political people, and I also talk to our county people. And there was a great deal of interest. I mean, like, well, at dinner parties or wherever, whoever got within 6 feet. And it so resonates with people. So I urge you to continue to learn, to continue to talk to people. You just never know who's going to be an important person. I put myself out there as the coordinator for New Jersey. It's on the website. All kinds of people find their way to the website. They're in New Jersey. They found me. We have a great group of people, from attorneys to political activists to housewives, right? Bakers, yes. So we did learn. Excuse me for jumping ahead, but we did learn that we can't do it at the municipal level in New Jersey. It has to be at the state level. It's unique in the country. That's controlled by the New Jersey Investment Council, so everything has to be statewide. So the issues in Princeton and in Mercer County, where I live, there's slight differences, but there's always a need for more money and less taxes. So this is a profit center that is unparalleled and very, very possible. So we are joining together and strategizing on how we can work at the state level. The problems are the same, they're bigger, there's more politicians, there's more people involved, but we will do it, and it'll take us a little time, but I urge you to stay involved, educate yourself, learn the various ins and outs of public banking, and you'll have a great deal of satisfaction, I'm sure. So, thank you. Thank you, Scott.
I realized that one of the things that my obligation I didn't do, and that was to tell you what's going on around the country, but that could make an okay sort of a transition for us here. Since we started a number of years ago, and Ellen, this thing got underway about 2011, she learned that there were a number of initiatives that were underway on the state level. Well, they've grown into many initiatives and many more on local levels. So heading from the West Coast east, we have this past week the city of Seattle with city councilmen from the city of Seattle and also Tacoma and also Spokane had a 2-day seminar and forum in Seattle to look at that city taking a public bank, which is a very exciting development because that's a major city. and those are major cities. The city of Santa Fe has issued an RFP already because their council is very much behind it, another very progressive city. I'm sorry. A request for proposal to study the effects and costs and benefits of having a public bank. In other words, they're serious about it. They intend to get on with this. And also, it's pretty far along in San Francisco as well. That is now you've got these are very big and complex political communities. You know, these are big cities have they have a lot of power centers that gravitate around them. So they're moving expeditiously, but very carefully, very carefully. They have to get the facts. We'll have to, it doesn't matter what the size of the market is, you have to find out what the facts are. What do we have? What's it costing us? How much do we save? You know, would it be on this side and this side? You know, you do a comparison, but you get the facts down, and then you can move forward with credibility. So there's San Francisco, Spokane, Seattle, Tacoma, and then Arizona there's a new committee that has started down there. There, of course, is the New Mexico, Santa Fe component, but there also is start in Albuquerque. Moving east, there's Texas. Believe it or not, the Tea Party Republican representatives who love this idea because they hate Wall Street and they don't like big government. They like local control, and which is one of the really wonderful things about this effort is that it's transpartisan. This is really about community interest. I don't care how you think you're going to get there. It's like all of us working together, and it's a local thing. So that's a very strong component of it, and I think it also bodes well for a political agenda as well for marshaling votes. Now, you know, when voters, by the way, succeed at getting people elected, or when voters come and say, look, you're going to be state rep here, if you want my vote, you've got to take a stand for public banks. I've been part of an environmental fight where we did just that, and it was a cross-section of people, all ages, all political stripes. But they said, look, we don't want you to build this pumping station to feed this nuclear plant. We wound up taking over the government. We took over the state rep, the commissioner's office, the water authority, and it was a wonderful example. In fact, it was right in the heartbed of the homestead of where George Washington crossed the Delaware back in the Revolutionary War, so it had a nice historical vibe. But this is our inheritance. This is America's inheritance. Now, moving further east. Chicago, there's a mayoral candidate in Chicago who has also got public bank as part of her stand. There was a candidate for the treasurer in Wisconsin who was on that, also had that. Ellen Brown, of course, ran for state treasurer in California on the Green Party, but no third parties can win in California almost by law at this point. Chattanooga, Brunswick, Georgia, Philadelphia, the city of Philadelphia is well along in developing its understanding and presentation of an ordinance for the city council. The new mayor in Pittsburgh, who's a progressive guy, is on board and interested in this very much. Allentown, Pennsylvania, that new mayor they're absolutely fired up about it. Reading, Pennsylvania, it was probably the first city in America to take a real strong look at this because they were broke. And they wanted to, they're under state receivership and management, so they have limitations of what they could do. But it's very interesting to see how the bankers and the political friends will maneuver assets away from the people, whether it's Reading or Pittsburgh or Detroit, where you see, I mean, in my opinion, this is amoral. To be able to, or immoral, to deprive people of water because they can't pay their bills. I mean, what have we become? And there will be no stop to this unless we, put a footprint of our own.
Did they have public banking in Detroit?
No, they did not, but a public bank could have saved that. That bankruptcy was not necessary. The bankers absolutely set them up for this, and this is, of course, what they're doing around the world. As you see, and this last little action with the G20 of writing in pensions and being able to take over the assets of the derivatives, in part is because the oil, as the oil derivatives start to come apart, it may be very soon that a lot of serious stuff happens. Well, I don't want to be, the dark cloud here, but I think we're all, just being aware is important. In Vermont, as Scott alluded, they've made great progress. They had a referendum, a would-be referendum, 18 out of 20 cities, towns voted to have a public bank. They told the legislature to do that. The legislature didn't do it, but they did decide that they would at least hand some of the money into their development authority to invest locally. So they took $50 million out of TD Bank in Toronto and put it into Vermont, because their study showed that it would generate a lot of more thousands of jobs and a lot more assets and so forth for the community. The numbers always show up in favor of the public bank, because you don't have these enormous fees and you're not paying the cost of money, you know? So it's, I'm going to stop it there. There's activity going all over the place. Now, the New York opportunity is, this is something that's going to be constructed as you guys find out what's so and what can be done.
So I've talked enough. I'd like to get some questions now in the back.
I admire what you're doing. I think it's fantastic. It's really great. However, I know something about international economics. I focus on economic theology. The real problem that you're not naming is economic freedom, as it's now understood, as it's now part of the trade system, the WTO and the trade agreements that economic liberalization means that there has to be freedom of banking. You read The Economist, they're completely critical of the Indian banking system because they are not enabling outside investors to control, to invest in the banks. So economic freedom is going to come at you from different directions, free trade systems particularly, but also the rhetoric of the powerful and the elite. How do you respond? Because the real point is, you guys are against economic freedom.
Well, freedom is another word for nothing left to use, right? But I think we all know that this freedom is really a misused word here. And it's like the free market, which never existed and never has and never will. Every government everywhere finds a way to favor something or other. We need to get them to favor the things that we think are important. And that's all I have to say.
You're also free to sleep under the bridge.
Hi, 2 points for me real quick. One is, one of the reasons I'm interested in all this is, goes to the funding of social projects and things like that. I'm involved in time banks and newer movement around mutual assistance networks. It is also getting some worldwide currency and a lot going on with that. And it comes down to you need some way to fund these things to kick them off, to get them going and keep them moving so that you can bring back the benefits to the community, which I support a lot, and I'm really happy to talk to anybody about that, and this is just another natural aspect of that. But I really want to camp a little bit on what Trent just said, and it goes back to what you both said about we can get enough people voting and stuff like that, we can put the right people in power and everything. I think the people in this room may be pretty aware of this, but we just elected a Congress and we've got a president that can hardly wait to pass 2 big so-called trade agreements right now, TPP and the Atlantic Partnership, okay, which are not trade agreements at all. They're completely about destroying your ability to do anything locally democratic to protect yourselves from worldwide commercial banking and industrialism, okay? And it means nothing when you put your faith in elections, okay? You're gonna have to find another mechanism to defend this whole project, because that's gonna be over probably within about 3 months from now. Because that's one of the highest priorities the incoming Congress has going on, and the president supports it too, okay? And that means within a year or so, you can't set up anything to protect your local community without somebody anywhere on the planet coming in and saying, well, you're cutting into my profit, so pay me. Okay, so I think that this is a wonderful thing. I totally support it. I want to do everything possible. I'm in New Jersey, so I'm going to be, looking you up real soon. And I'm involved in a lot of these national and international efforts around time banking and all these other things. But we have, as you said, it is a grim picture, and we really need to, we're looking at maybe something like the 1,000 years since the Caesar crossed the Rubicon, you know, it's like,
Right.
it could be a real dark time for a long time.
Yeah, yeah. Well, and I'm glad to hear of your interest and pursuit of, in development of the alternative methods of currency and exchange, because I think you're right. There's no way we're going to win our effort here by running against the big powers. It's just not going to happen. And of course, the lies and the verbiage and all that stuff will be coming at us rapidly. But everybody does, one of the things that's in our favor is that people have a very personal experience of how the economy doesn't work for them.
Oh, yeah.
And of course, they've lost so much of their assets and their homes and their educational prospects, et cetera, that people know that something needs to be changed and they're not part of that game. As George Carlin so beautifully said, it's a big club and you ain't in it. You and I are not in the big club, and they're coming for everything, and they'll get it, he said, and he's right. This is kind of a revolutionary sort of a sell we're talking here. But what do you do if you're not going to wing the big picture? You create alternatives, and you go around the side. You do the end run. You start to work together in alternative currencies, or in new public banking. Course, get a license. Talk to your community banks themselves. Those licenses, which are diminishing, may be convertible into some sort of a public bank approach. In fact, we make a strong point of wanting to let community bankers know that we are their BFF. We are the possibility that community banks can come back with real strength and real meaning in terms of providing local credit, which is all we're talking about. So let's look to one another and work with one another about some of these, and learn about some of these alternative ways.
These last two comments actually set up my question very well. I think we all realize that the system has to be changed, and it will be very, very difficult to do so, especially in New York State, where Wall Street exists. So my question is, what role do credit unions play? And would it be advisable to work with something like a credit union, instead of trying to change the system completely from the beginning? Use what system is already in place and see if we can institute change that way through something that already exists.
Actually, Tula asked me about this too. I think, there's nothing that prevents both of them from having credit unions and public banks. The problem is that credit unions are set up that you have to be in the union in order to get the credit. So the banks have actually fought the credit unions from expanding, and they would probably almost certainly fight them from expanding, from getting credit from the public bank as well. So I think they're very useful, and they're very localized, and they're good for the community, but I don't think they're going to scale, and they're certainly not going to protect us from these bail-ins and these big plans that the big banks have the next time their derivatives blow up. That's just not going to help us. And the state could lose the money too. If the state loses money, your credit union, you may have money personally, but the state will have to shut down, and then everybody's going to suffer as well.
I think I have a contrasting view to that. The credit unions have limitations on what they can do on commercial lending and so forth. And it's my understanding that credit union, the membership can be extended very broadly. So they do have applicability in a variety of ways. The spirit of my response would be that, yeah, they could be very helpful in the picture, because I believe, like community banks, they would be recipients of what a local public bank would be able to support. A public bank meaning the backstop for local lending as determined and assessed by local professionals, community bankers, credit unions. So my feeling is that a public bank would partner with them as they would, as in North Dakota, they partner with the development authorities and a variety of other agencies. So there's a broad range of serviceability that a public bank would do. But by all means, I think your money is probably safer in a credit union or a community bank than in one of the big banks. Because if this scenario shows up, whenever it shows up, I don't think all banks are gonna be at the same risk of exposure. Now, obviously, if you're in Wells, that's one level, but if you're a little community bank, you're probably not in that market so much, and you should be able to cover those losses. That's at least my view. So I think it's safer to bank locally, than with the big guys.
As one who grew up with a father who was a New York City fire captain, who talked about the financial oligarchy, and I used to always just turn my ears off 40 years ago. In 1992, I was working in Germany, and there's a photograph of a guy who was, everybody says is going to be the next president of your country because the bankers in Baden-Baden just chose him. And I said, oh, come on, this is something my father would say. His name was William Jefferson Clinton, who we had never heard of.
That's right.
And over the next 6 months, all the travails he had, he became president, and we're working in Munich at that point, and none of us believed it. The question is, in New Jersey, well, I'm from the foreign country, New Jersey here, ma'am, how is it that we can recognize the people who really run the thing? In New Jersey, Governor Christie's not going to stop this from happening. It's the guy who runs New Jersey. His name is George Norcross.
Yeah.
How do you stop George? Can we set up a county bank or a town bank in northern New Jersey?
Well,
or is that
yeah.
not law?
The law in New Jersey is everything, that the municipalities have no power, they have limited power, and they're very specific where they can invest. So they have to send all of their money to.
What the designation?
To the New Jersey Investment Council. Sorry. And it's controlled, it's on the website, you can see New Jersey Investment Council. They have meetings every other month, they're open, haven't been to one yet, in minutes, but yeah, they cover everything. They handle everything. Now, Norcross is not on that.
Doesn't have to be.
Yeah, right.
I'm sorry.
Yeah, oh, no, we're well aware of the deals that have been made with Christie and Norcross, yeah.
For our brothers and sisters in New York State, the joke is in New Jersey, Washington couldn't cross the Delaware now without King George III's approval. I'm not overdoing it, folks. He's that powerful, and he's a Democrat.
He's a Democrat, yeah.
Uh-huh.
So we couldn't have a county bank set up?
Well, one of the things that in New Jersey is, the process in New Jersey is uncovering, is that we look at what's possible. You have to go back to the municipal financial regulations that are, that have been adopted by the legislature. You basically need the permission of the legislature to do anything different. But they do have approved depository institutions, some of which are community banks, many of which are community banks. So part of the strategy would be to, and I think Joan is aligned with this, is that to go to the Development Authority and to start to begin to make the case publicly about how much of their money is going out of New Jersey, which is huge, and saying, why are you investing in Iran? Or investing in oil in the Middle East, et cetera, et cetera. That is to say, just to be able to get the facts on the table. And then start to make the public aware in the process of that. But they're also, it also puts you in a situation of having to be creative about, well, what could we do? How could we create new, perhaps collaborative, not necessarily countywide, but perhaps regional banking institutions, depository institutions that might be derivatives of existing approved agencies? Those are good questions, and the sort of things that the public banking work around the country has to deal with. The state of Washington, for example, has its limitations on what cities can do with their deposits, but they're going to find out. They'll work through it. They'll work through it. Yeah, Manny.
When the Federal Reserve Bank was 6 years old, the Bank of North Dakota was grandfathered into the system, and they can get low loans. Mr. Baker, once the people of New York State have their banking license, what guarantees are there that, because the Federal Reserve Bank is now run by the too big to fail banks, pretty much, that we can get those low interest loans?
Well, there's no guarantee. I mean, we have to fight for that as we have to fight for everything else about the public bank. Yeah, you're right. I mean, it's grandfathered in, and in fact, the Federal Reserve in Massachusetts, Boston, they put out a report, and they specifically mentioned how it was grandfathered in, and according to them, it was unlikely to be grandfathered in for some other new public bank. But of course, they came out against public banking because they're the Fed. But that's one of the things we have to fight for. I mean, this is just part of what we're going to have to try and get. I think, I was at the protest march yesterday with 25,000 people about police brutality and overreaching and, the things that happened with Michael Brown and Eric Garner and so on. And that only took a couple of weeks to put together. There were 25,000 people, according to the New York Times. I saw it on Fifth Avenue, people of all kinds, all colors, all backgrounds. We need that. We need enough people who say that we want our own bank, we want our own money invested in our own community. I mean, it's a very broad sell. I mean, we want our money back. This is not something that should go to Wall Street. It's not for gambling. It's not for speculating and killing the economy. I mean, I can't believe what they just passed in the Senate where we have to bail out the derivatives industry. I mean, what the hell is this?
Who has the money for that?
Yeah, but nobody has money for that. Well, that's the thing too. I mean, it's not even as if this thing is gonna work. I mean, there's not enough money in the entire world to bail out the derivatives industry. And you got $1.2 quadrillion, that's not, no governments in the world can bail it out. So, we have to make people aware of this and they have to be focused on solutions.
I think, I was just gonna say, it's ironic that in passing the bill to keep the government open until next September,
Right.
we're gonna bail out the banks. That
Well,
was the deal, but that was the deal.
Go on Op-Ed News, read my article about how Obama can combat the austerity thugs, and I think that's the title of it, something like that. And it describes how he could, if he had a spine and if he had the willingness, how he could combat this and how he could actually keep the government open using the Constitution. Because we have Article 6 in the original Constitution, which says all debts will be paid from the original Articles of Confederation. And we have the 14th Amendment, which says all debts should be paid going forward. So we have two places in the Constitution which say debts must be paid. These are debts that we've incurred. They're not new debts, they're debts that Congress said they were going to pay. And according to the Constitution, the President has a possibility, at least, and other people have put this forward, it's not my idea. He could create $1 trillion coin. He could tell his Treasury Secretary, let's reprint United States notes, which were debt-free money that came from President Lincoln. This was our longest lasting currency. It's coming right out of Treasury. You don't need a bank. There's no interest, there's no debt. His former Transportation Secretary, Ray LaHood, tried to do this in H.R. 1452. He tried to create interest-free money for the highway bill in the amount of $350 billion. Now, of course, it never got out of committee because we know why. But it was a good bill, and he specifically referred to Lincoln and said that this would be interest-free money. It would cut the cost of highway construction in half, as we saw in the slide there, because you get rid of the interest. So,
Yeah, but Obama supports the bill.
it's in opednews.com. Look me up. I'm Scott Baker. I've got 200 articles.
Now, my question is, I sent, not to anybody, nobody here, but I sent to my local NAACP, the president in my local area in Westchester, that I was coming here, and did she want to send somebody? And she said, frankly, we are concerned about the economy. I mean, I'm not bad-mouthing her, but she said our current focus is criminal justice. Now, there is no doubt about it, criminal justice is a major issue.
I think they're related.
Yeah, they are related. Can you put into words, I have three jobs, but can you put it into words more graciously than I do?
There's so many ways to do that. I mean, I read an article today about the minimum wage and how basically, if you don't have a minimum wage, that's a livable wage. First of all, the government's picking up the other half of your pay, basically, through all the subsidies, which means we're subsidizing Walmart and McDonald's and every other big corporation. The top, according to Bernie Sanders, the top 7 people, the Waltons who own Walmart, they have more wealth than 40% of Americans. I mean, this is just, you can't even get your mind around this stuff.
The aggregated wealth.
Yeah, the aggregated wealth of the bottom 40% of America, the top 7 people, the Walton family, have more wealth than them. And of course that understates it because of all their political power. They have even more than that. But, we have to coalesce around the understanding that the economic power is also political power. Gentleman back again?
the movement to restore the right to create money is a wider movement than just the state banks.
Absolutely.
I have facilitated the head of the American Monetary Institute who wrote The Lost Science of Money. And I
I
know,
met him 4 times.
I forget his name.
Steven Zerlinga.
Of course. He was very critical of the state bank process, wanted a amendment to the Constitution, and had many congressmen lined up, and he was very anti-Ellen Brown.
Yeah.
Can you update us on this?
I can tell you my personal experience with Mr. Zelinga because I've met him 4 times and I talked to him, and he's irascible, and he's upset with me for promoting public banking
Have you read his
specifically.
book? That's all he asks.
Yeah, I mean, I think he's done a great job. He's done a great book that everybody should read who's interested in monetary reform. I disagree with him, obviously. I think if you look at Bill Still, who's another monetary reformer, he was trying to get Ellen Brown to run with him on the Libertarian ticket for president and vice president respectively. He tried to get her as a VP candidate, and obviously he saw a way to make a public banking advocate work